You are sitting in your living room, but you feel like you are in a cage. You own a beautiful home, yet your bank account is almost empty every month. On paper, you are wealthy because your property value has increased significantly. But in reality, you are struggling to buy groceries or fix a leaking faucet. This is the painful paradox of being house poor in 2025. Society told you that buying a house was the ultimate path to financial freedom. They told you that renting was simply throwing your money away every month. But they forgot to mention the hidden costs that are now draining your life. The traditional rule of thumb says you should spend 28% of your income on housing. In today's world, that rule is effectively dead for millions of hardworking people. Many households are now spending 40 or even 50% of their gross income just to keep their front door locked. This is not just a financial problem, it is a psychological burden that affects your health and your relationships. The stress of waiting for the next thing to break can keep you awake at night. You look at your neighbors and wonder how they seem to afford it all so easily. But the truth is that many of them are one broken water heater away from total financial collapse. We have been conditioned to believe that a bigger house equals a better life. We have sacrificed our hobbies, our travel, and our peace of mind for an extra bedroom we rarely use. But today, we are going to stop being victims of our own mortgages. We are going to move past the complaints and build a real plan to take back your control. This is a deep dive into the 5 pillars of surviving and thriving when you are house poor. The first pillar is performing a ruthless audit of your home insurance. Most homeowners simply pay the renewal bill without questioning the increase. In many states, insurance premiums have jumped by 20 or even 50% recently. You must stop viewing insurance as a fixed cost that you cannot change. Call your agent and ask for a higher deductible to immediately lower your monthly premium. Ensure you are not paying for coverage you do not actually need for your specific area. For example, do not pay for earthquake coverage if you live in a low-risk zone. Look into parametric insurance options that pay out based on specific weather events. This can sometimes offer a more affordable layer of protection for specific risks. If your company will not negotiate, you must be willing to shop around every single year. Loyalty to an insurance company often costs you thousands of dollars over time. Ask about bundling your home and auto insurance to find hidden discounts. Sometimes, installing a simple smart water leak detector can lower your rates. The second pillar is accepting the new reality of home maintenance costs. The old advice was to save 1% of your home value for repairs every year. With the current cost of labor and materials, that number is no longer enough. You should aim to set aside at least 2% of your home's value annually. If your home is worth $500,000, you need $10,000 in reserve. If you are not doing this, every repair becomes a high-interest credit card emergency. Prevention is the only way to stop your house from eating your retirement savings. Clean your gutters twice a year to prevent thousands of dollars in water damage. Change your air filters every single month to extend the life of your heating and cooling system. Inspect your roof after every major storm to catch small leaks before they destroy your ceiling. A small investment in maintenance today saves you from a massive catastrophe tomorrow. If you cannot afford the 2% rule, you must learn basic, do-it-yourself skills. The internet is a free university for plumbing, painting, and basic electrical work. Every repair you do yourself is money that stays in your pocket instead of a contractor's pocket. You can save hundreds of dollars by simply learning how to recaulk your own bathtub. The third pillar is a modern approach to what we call silver house hacking. You might feel that renting out a room is a violation of your privacy and comfort, but you do not have to live with a stranger to generate extra income from your property. Look at your garage or your basement as a potential storage unit for others. People are desperate for secure places to keep their boats, trailers, or extra furniture. There are apps that help you rent out your attic or garage as a mini storage facility. You can rent out your driveway or a parking spot if you live in a busy area. This allows you to earn hundreds of dollars a month without anyone ever entering your home. If you have a large backyard, consider renting it out for dog owners through platforms like Sniff Spot. This income can directly offset your property taxes or your monthly utility bills. It turns your dormant asset into a working machine that pays for itself. Some homeowners even rent out their swimming pools by the hour during the summer months. The fourth pillar is the often overlooked strategy of property tax appeals. Local governments assess your home value to determine how much tax you owe. These assessments are frequently inaccurate and based on outdated or incorrect data. You have the legal right to challenge your assessment if you believe it is too high. Look at the sold prices of similar homes in your immediate neighborhood. If your neighbors are paying less for similar houses, you have a strong case for an appeal. Gather photos of any damage or issues that might lower the market value of your property. Many people win their appeals and save thousands of dollars on their annual tax bill. It requires some paperwork and time, but the return on investment is massive. Do not assume the government has calculated your bill correctly. Most people never even try to appeal because they think the process is too complicated. In reality, most counties have a simple form you can fill out online. The fifth pillar is understanding the timing of strategic refinancing. Many homeowners are trapped in high interest rates from the last few years. Do not rush into a refinance the moment rates drop by a small fraction. You must calculate the closing costs and determine how long it will take to break even. If you plan to move in 2 years, a refinance might actually lose you money. Wait for a significant drop that allows you to recover your costs within 12 months. When the time is right, refinancing can save you $300 to $500 every month. That is money that can go directly into your emergency fund or your retirement account. Consider a 15-year mortgage if you want to build equity much faster and save on interest. But only do this if you are absolutely certain you can afford the higher monthly payment. When you are desperate for every dollar, you cannot afford to take risks at work. You might stay in a toxic job because you are terrified of missing a single mortgage payment. You lose your bargaining power and your ability to pursue better opportunities. Breaking the house-poor cycle gives you back your career freedom and your ambition. Being house-poor is a season of life, not a permanent identity. It requires you to be more disciplined and creative than the average person. You must be ruthless with your budget and protective of your cash flow. Cut every subscription and luxury that does not bring you genuine joy or value. Focus on building a small buffer of at least $1,000 as fast as possible. If you have tried everything and you are still drowning, you must be brave enough to consider selling. There is no shame in moving to a smaller home or a more affordable area to find peace. Renting for a few years to rebuild your savings is a very smart financial move. Your worth as a human being is not defined by the square footage of your house. Real success is having a home that provides security instead of constant anxiety. You deserve to sleep soundly without worrying about a broken pipe or a tax increase. Start with one pillar today and take a small step toward your financial freedom. Audit your insurance or look at your neighborhood tax records this weekend. Control the things you can control and stop worrying about the national economy. The housing market might be crazy, but you can still make sane decisions. You have the power to change your situation if you are willing to act. Your home should be a place where you build memories, not a place where you bury your dreams. Stop letting your mortgage dictate how you feel about your life every day. Take a deep breath and remember that you are in charge of your future. You can break the cycle and find your way back to financial stability. It will take time and effort, but the peace of mind is worth every single minute. Focus on the long term and do not get discouraged by temporary setbacks. Your future self will thank you for the hard choices you are making today. Good luck on your journey to taking back your life from your mortgage.